The Precious Metals Week in Review, July 24th, 2015. Brought to you by Precious Metals International. Volatility continued this week. The Dow Jones Industrial Average turned negative for the year again this week, as earnings reports this week came in surprisingly negative, and weak data out of China spooked investors. The number of Americans filing new applications for state unemployment benefits posted a shocking drop last week, plunging by 26,000 claims to a seasonally adjusted level of 255,000 for the week ending July 18th. The 255,000 figure marks the lowest level for unemployment claims since November of 1973, more than 41 and a half years according to the U.S. Labor Department. Claims for the previous week remained unrevised. Many analysts and even mainstream media outlets shrugged off the massive decline by pointing out that the data is likely an over-exaggeration due to typical summer volatility. Such extreme volatility can be brought about by automobile manufacturers that seem to more frequently choose to keep production lines operating instead of shutting down for retooling. Manufacturers that decide to keep the production lines running throw off the calculations used by the government to smooth out seasonal variations in the data. In China, the preliminary Caixin Market China Purchasing Managers Index, formerly titled the HSBC Market China Purchasing Managers Index, came in at 48.2, a 15-month low for the index, and marking the fifth straight month that it has been below the 50 level that separates economic expansion from contraction. Analysts had expected an increase to 49.7 from June's level of 49.4, so the drop took them by surprise. After the figure was released, the Australian dollar plunged to its lowest level against the US dollar since May of 2009, during the height of the global financial crisis. China is one of Australia's largest trading partners, and a weaker economy there translates into weaker exports for Australia. The surprising PMI figure also seemed to trigger another sell-off on the Shanghai Composite, which reversed gains that it had made this week and closed down 1.3% for the week. China's stock markets are still recovering from the recent 30% drop. The previous stock plunge was finally halted by direct intervention on the part of the Chinese government, which put a ban on new initial public offerings and moved to prevent large stakeholders from selling their substantial shares of stocks. A renewed plunge in Chinese stocks, triggered by renewed fears over the state of the economy, could add further contractionary pressure to an economy already frequently described as slowing. Ray Dalio, a longtime bull investor in China at Bridgewater Associates, wrote to his clients saying, "Our views about China have changed as a result of recent developments in the stock market." The note continued, saying, "There are now no safe places to invest, and the environment looks riskier, which we would expect to encourage the holding of cash and lessen the marginal effectiveness of easing monetary policy." Elsewhere in Asia, South Korea's economic growth for the second quarter slowed dramatically, hampered by the recent outbreak of Middle East respiratory syndrome (MERS). The South Korean economy grew at a meager rate of just 0.3% in the second quarter, falling from a growth rate of 0.8% in the first quarter. The battered country declared this week that the MERS outbreak was over, so hopes are that the third quarter may see some rebound as consumer fears subside and they begin to venture out of their homes again to contribute to the economy. In Greece this week, Prime Minister Alexis Tsipras managed to rein in a rebellion within his Syriza party that was triggered by last week's approval of the first set of reforms required for consideration of yet another bailout for the debt-laden country. The first set of reforms, which passed in Parliament last week, focused mainly on increasing taxes and forcing stricter adherence to budgets. A second set of reforms was put before Parliament on Thursday, which covered dealing with failed banks and streamlining the justice system. The second reforms package was also passed by the Greek Parliament despite 36 Syriza members abstaining from or outright voting against the packages. The ongoing split within the Syriza party, which came to power on a platform of rejecting austerity measures, which were imposed on Greece as a condition of its previous bailouts, is widely expected to trigger snap elections by September or October, as Mr. Tsipras's governing coalition weakens further. Snap elections taking place just as Greece begins negotiations for additional bailout funding would likely throw everything right back into massive turmoil at the worst possible time. Following the Greek parliament's approval of the latest reforms demanded by international lenders as a precondition for opening talks regarding another bailout, the IOBE Institute, a prominent think tank in Greece, said in its quarterly report that the capital controls recently put in place to alleviate bank runs would likely trigger a steep recession and further economic contraction. On Friday morning, Greek banks began easing those capital controls by doubling the daily limit on money transfers by businesses to 100,000 euros in an effort to boost desperately needed imports. Greek Central Bank Governor Yannis Stornaros told reporters that the increase covered nearly 70% of requests, saying, "As far as transfer approvals are concerned, we are now very close to the monthly imports the Greek economy was registering before the crisis." Brent crude dropped under $50 this week as U.S. crude inventory posted yet another surprise increase, and the U.S. oil rig count posted a surprising jump. According to the Energy Information Administration, EIA, U.S. crude stocks jumped by 2.5 million barrels last week. Analysts had expected a drop of 2.3 million barrels, so the increase was a complete surprise to them. The euro began the week trending sideways against the US dollar, but surged higher on Tuesday. Late Tuesday, the euro began drifting downwards against the dollar again, but recovered by Wednesday and began moving higher. The euro appears set to close the week higher against the US dollar. The Japanese yen began the week moving lower against the US dollar, but also surged higher on Tuesday in tandem with the euro. The yen saw similar moves to the euro for the rest of the week, drifting downward on Wednesday but quickly finding a floor. The yen also appears set to finish the week slightly higher against the US dollar. Volatility should be expected to continue. Weak earnings reports in the U.S. from major multinational companies this week further highlighted the global interconnectivity of today's markets. Economic weakness in China appears to once again be the driving factor for recent market moves. The drop in the Caixin Market Flash PMI index, indicating further contraction ahead for the Chinese economy, seems to have triggered another sell-off on the Shanghai Composite. Fears that there may be global spillover from that projected contraction seem to have spread into global markets as well. Many of the less than spectacular earnings reports in the U.S. this week seem to directly place blame for their woes this quarter on China's sluggish economy. In early Asian trading hours on Monday, investors dumped more than $500 million worth of bullion in New York in 4 seconds, with selling occurring almost simultaneously on Chinese markets. You'd be forgiven for believing that those are the words of the usual gold bugs that are nearly always relegated to the fringes by the mainstream media. Those are the words of Manolo Serapio Jr. and Ruby Leon, 2 Reuters reporters out of Manila, Shanghai. The Reuters article continued to discuss Sunday night's obvious and deliberate smash to the gold price, saying, "The fact that the sell-off occurred while Japan's markets were closed for a holiday and U.S. and European traders remained on weekend leave served to implicate China-based dealers in the eyes of some market participants." The article quoted one gold trader saying, "That move was aggressive manipulation. Somebody clearly wanted the market lower and timed it very well." One anonymous London-based trader speculated that the culprit may not have been based in China as suspected, saying the selling was on COMEX and could also be a non-Chinese fund just executing in what they thought was an illiquid time zone to get the biggest move. The smash is widely being blamed on nervousness brought about by China's surprise release of its official gold reserves data last Friday, which turned out to be a lower quantity than everyone expected. Of course, given the suspicion surrounding the release of official economic data out of China lately, it is entirely possible that the official size of China's gold reserves also contains inaccuracies. It is also worth noting that the Wall Street Journal, WSJ, reported that the striking plunge in the Asian market triggered an accompanying spike in demand from both China and India, causing premiums on physical gold to nearly double. The same WSJ article also noted that sales of gold coins from Perth Mint suddenly rose sharply this week in conjunction with the price smash. Both India and China are approaching their typical peak buying seasons for gold, and the sudden price drop, triggered by blatantly obvious not-for-profit sellers on Sunday, appears to have been viewed in both countries as nothing more than just another buying opportunity to purchase additional precious metals at a discount. In Europe, the situation in Greece seems to have cooled momentarily, but the problems that led to the standoff with its international creditors these last few months still remain. Despite the Greek parliament passing the latest series of reforms that its international lenders required before they would even sit down at the negotiating table to discuss additional bailout funding, the political cost to Prime Minister Tsipras may result in a call for snap elections in September or October, which could once again reverse the very reforms they just approved. Such an event would throw any ongoing bailout negotiations for Greece into complete disarray once more. If earnings in the U.S. continue to come in weaker than expected, it may simply serve to point out that the U.S. economy, widely touted as being on the road to serious recovery, is doing nothing more than stumbling forward and about to be reined in by global interconnectivity once again, as China and Europe continue to slow. If China and India truly doubled their demand for gold, as reported, upon this week's price smash on Sunday night, then they clearly do not believe the mainstream media's historically unprecedented negative attitude towards precious metals. Such an obvious and manipulative event as Sunday's smashdown being discussed so openly and candidly in widely respected investor publications may finally be signaling that the manipulators are starting to lose their control as they grow more blatant in their last desperate efforts to keep prices at suppressed levels. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, July 24th, 2015. Brought to you by Precious Metals International.